Hello. This video is going to be part 2 of study unit 1 to finish off the remaining parts on the first study unit on capital budgeting cash flows. So if you remember, last time I took you through the notes on how to calculate the initial investment, and I also gave you some background on some important terminology that you need to know in capital budgeting. In this video, I am going to look at the remaining part associated with capital budgeting, which is mainly an example on determining the initial investment. And then after the example on determining the initial investment, I'll take you through the operating cash flows and the terminal cash flow. So for an example on the initial investment, I'm going to look at a question from semester 1, assignment 1. This question right here, question number 1, semester 1, assignment 1. So we're given a company that's been operating for a number of years, and we've been told that this company wants to increase its production and sales, and they're considering replacing one of their machines that produces yogurt with a technologically advanced model. We're given details of the current machine, the cost price of the current machine, how much the current machine can be sold for, the variable cost the current machine is giving us, the selling price per unit, the useful life years of the current machine and its output per year, the fixed costs, and we were told that the machine has a life of 4 years. It was purchased 4 years ago. We are told that the new machine will have installation costs of 20,000 Rand and will have a useful life of 5 years, after which it will be sold for 150,000 Rand. The new machine will decrease working capital by 7,000 Rand. And we've been told if they purchase the new machine, output is expected to increase by 19%, and the selling price per unit is expected to decrease by 8%. Fixed costs will remain at 15% of annual depreciation for both machines. And we're told that both machines are written off on a straight line basis over the useful life. The discount rate, required rate of return is 10%. We'll talk more about this. The income is taxed at 28% and the capital gains at 28%, right? And then we are asked to determine the initial investment, the incremental cash flows, the terminal cash flow, and then the net present value. So I want to focus on the initial investment since I gave you some background on this. So I want to show you how we would calculate that. So to determine the initial investment, like what I told you in the previous video, we have to start by putting our template. So you always start by putting your template. Your template consists of the installed cost of the new machine, and then you add the after-tax proceeds from the sale of the existing asset. Then it's plus or minus the change in net working capital. So you need to find each of these three things to be able to calculate your initial investment. So I'm going to take you through how you would calculate each of those things. And then after taking you through how you would calculate each of those things, I will then take you through the remaining parts with regards to capital budgeting and cash flows. So firstly, the installed cost of the new asset, of the new machine, I put 770 there. To calculate the installed cost of the new machine, I just took the cost price of the new machine. The new machine will cost 750, and I added the installation cost. So I said 750 plus 20,000, and I got 770,000. Please remember that if there was delivery, we would also add delivery expenses. And please remember, we do not add sunk costs. We don't add consultation expenses and marketing expenses for the installed cost of the new asset. We just look at how much we pay for the new asset plus delivery and installation expenses. Okay. Then the next item we have is the after-tax proceeds from the sale of the existing asset. So remember, the installed cost of the new asset is always put as a negative because it's money going out. Then we have money coming in through the after-tax proceeds from the sale of the existing asset. Now, to get the after-tax proceeds from the sale of the existing asset, we take the selling price of the existing asset plus or minus tax, right? And sometimes we are not given this tax. So to calculate that tax that we might not be given, we take the selling price of the existing asset. We take the selling price of the existing asset to get to the tax. Selling price of the existing asset less book value of the existing asset multiplied by the tax rate. And then sometimes we are not given the book value of the existing asset. And to calculate the book value of the existing asset, we take the installed cost of the existing asset minus the accumulated depreciation. Okay. So let's just go through this calculation. So the way to do this part, you go to your question, right? And you see if you've been given the selling price of the existing asset and if you've been given the tax. If you have, it's simply a matter of just adding or subtracting these and you get your answer. But if we go to the question, we were just given the selling price of the existing asset. We were told that the resale value of the existing asset is 70,000, right? So I'm going to highlight the values that we had. So we were given the 70,000, right? But we were not given the tax. We were just given a tax rate. So I had to calculate this value of 0. I had to calculate this value. And then the way I calculated this value of 0, I used the following formula. I took the selling price of the existing asset minus the book value of the existing asset times the tax rate. So I was given the selling price of the existing asset and I was given the tax rate, but I was not given the book value of the existing asset. So I had to first calculate the book value of the existing asset. And to get the book value of the existing asset, you take the installed cost price of the existing asset minus accumulated depreciation. So according to the information we were given, we were told that the current machine had a cost price of 350,000. That's the installed cost of the existing asset. And then our accumulated depreciation is installed cost of the existing asset, which is 350, divided by the useful life of the existing asset, which is 5 years, multiplied by the age of the existing asset. We were told the machine was purchased 4 years ago, multiplied by 4. So it's 350 minus 350 over 5 multiplied by 4. That will give us the accumulated depreciation. This part is the accumulated depreciation. So I calculated the accumulated depreciation is 280. And then I said the installed cost of the existing asset minus 280, that gives me 70,000. So this was my book value. And then I took that book value and I substituted it here. And then I said selling price of existing assets minus book value of existing assets times the tax rate. That gave me 0. And then I took this 0 and I substituted it there. And then I said 70,000 plus 0 to give me my after-tax proceeds from the existing asset of plus 70,000. Please note, you have to start with this template, but you check to see if you've been given the information. Sometimes you'll be told that the tax benefit is this amount. And if they tell you what the tax benefit is, you just simply add it and then you get the after-tax proceeds from the sale of the existing asset. So if they tell you what the tax expense is, but sometimes you actually have to calculate the tax like what I did. And sometimes you actually have to calculate the book value and then you have to substitute in so that you can get your after-tax proceeds from the sale of the existing asset. So that's how I got the 70,000. And then lastly, the change in net working capital. So here we are told that the use of the new machine will decrease working capital by 7,000. We are told that the use of the new machine will decrease working capital by 7,000. So it means we have a negative change in net working capital. It means we have a negative change in net working capital. And if you remember, in the previous video, I told you that if the change in net working capital is negative, it means that money came in from the finance in the form of current liabilities. So we add. So this 7,000, which we've been told that's decreased. This is money coming in. When our net working capital decreases or it's negative, it means money came in. But if it increases or if it's positive, it means money went out. So we put this as a positive because money came in. And then we can do our calculation, and that gives us the initial investment of 693,000. Okay, so you can rewind if you didn't get that properly, and you can just go through it again. That's how we calculate our initial investment, right? So in the video last time, I finished off by talking about the initial investment. But remember, I said we have 3 types of cash flows that we need to calculate. The next important type of cash flow that you need to be able to calculate is known as the operating cash flow. Operating cash flow, or it's also known as the incremental operating cash flow. Remember, we have 3 types of cash flows that we need to be able to calculate. And you need to be able to calculate the initial investment, which is what I just showed you through an example, and I took you through last time through the video. And next, you need to know how to determine the operating cash flows. And for each year, the asset is operating, it's going to be giving you cash coming in. So I just want to take you through how to determine the operating cash flows. Okay. So the operating cash flows, we can just define these as the cash flows that you get from operating the asset or from the capital project. Each year you're going to get money coming in as a result of using your asset or your capital project, and we call that an operating cash flow, right? And when it comes to capital budgeting or capital projects, there are 2 main reasons for a company to conduct a capital project. A company might conduct a capital project for replacement, meaning to replace an existing machine, or for expansion, meaning to expand its operations. The most common reason for a capital project is for expansion. This is the most common reason why a company would purchase a capital asset. They would want to expand their current operations. Now, when we're talking about operating cash flows, the cash that you get from an asset from operating it each year, we have what we call incremental operating cash flows, and then we just have ordinary operating cash flows. When we are dealing with a project involving replacing an existing machine with a new machine, we say that we have incremental operating cash flows. When we are dealing with replacing an existing machine with a new machine, we say that we are working with incremental operating cash flows. And when we are expanding, we just work with operating cash flows. Okay. When we talk about incremental operating cash flows, we're talking about something like this. I showed you an example last time. This is an example of an incremental operating cash flow. Let's say before you purchase a project, your existing asset is giving you 200,000, right? Like let's say with the current asset, you're getting 200,000 each year. But let's say you decide to replace that asset with a new asset. If you get a new asset and the new asset gives you 320,000 rand, we are replacing this one with a new one, with a new asset. If we are replacing an existing asset with a new asset, we are concerned with what we call the incremental operating cash flow, which is the difference between what we are getting now after the new asset and what we were getting before the new asset. So with the replacement problem, we are concerned with the incremental operating cash flow. But with an ordinary expansion problem where we're just expanding, we are just concerned with the operating cash flow from the new asset. We are not concerned with the difference between the existing and the new asset. So this is some important theory you should know. In the exam, they could ask you, when do you use incremental operating cash flows and when do you just use the operating cash flows from the new project or the new asset? Incremental operating cash flows are used in a replacement problem, and just operating cash flows are used in an expansion problem. So next, you need to know the template on how to calculate your operating cash flows, and I've put the template up here. Here it is. So the template is the basic structure of an income statement. The only difference is with an operating cash flow template, you don't have interest expense. The basic structure is as follows. You take your revenue, which is your sales, then you subtract your cost of sales, also known as the variable cost, and that gives you your gross profit. And then from the gross profit, you subtract operating expenses, also known as fixed costs, and you subtract depreciation. Sometimes they can say operating expenses include depreciation. If they say that, you don't have to subtract depreciation again if it's included in the operating expenses. So it's gross profit less operating expenses less depreciation. Then you get your operating profit, which is your EBIT. Then you subtract tax, and then you get NOPAT, your net operating profit after tax. And then after getting your net operating profit after tax, you add depreciation to your net operating profit after tax, and that gives you the operating cash flow. So this will be the operating cash flow for each year. So this is the basic template. So like I've said, sometimes they will want you to do the incremental operating cash flow, which is the example I'm going to show you from the assignment. With an incremental operating cash flow, you get the cash flows for, you do the operating cash flow calculation for the existing asset, and then you do the operating cash flow calculation for the new asset, and then you subtract these two to get the incremental operating cash flow. That's if it's a replacement capital budgeting project. But if it's just an expansion capital budgeting project, you are just calculating the operating cash flow for the new asset only. You don't have to do for the proposed and the existing and then find the difference. So just to illustrate to you how this calculation is actually done, let's look at that example we've been looking at, question 1.2, assignment 1, semester 1, 2020, question 1.2. Okay, let's just look at that. So part 1.2 says, calculate the incremental cash flow associated with the new machine. So they want the incremental operating cash flow. And the reason they want the incremental operating cash flow is that we are replacing, it's a replacement problem. We are replacing the current machine with a new machine. So we are concerned with the incremental operating cash flow. So to do this, you have to reconstruct your income statement, and you should get something like this. I'm going to explain where all these things are coming from, what they mean. So you'll notice what I did for my template. I created a column to calculate the operating cash flow for the current machine. And then I also put in a column and I did the calculation for the proposed machine, right? And then I got the increment. The increment is simply everything in the proposed minus everything in the current. It's just simply this minus this, and then we get the increment. It's the increase. And what we were asked to calculate is this one right at the bottom, the incremental operating cash flow. So let me just take you through this table to show you where everything in this table came from and how I constructed this. Okay. So according to the question, we were told that the current selling price is 18 Rand. We were told that currently the selling price per unit is 18 Rand. Let me just see, there it is, selling price per unit. And we were told that the variable cost is 12% of sales, right? So I simply said the number of units currently being produced, which is 6,600, multiplied by 18, that gave me the sales. Then I said 12% of the sales gave me the variable cost. Sales minus variable cost gives us the gross profit. Then I subtracted the fixed expense. We were told that our fixed expense is 15% of depreciation per annum. So remember, depreciation per annum is 70,000 Rand. I got this 70,000 Rand, the depreciation per annum, by simply taking the cost price of the asset divided by the useful life of the asset. 350 divided by 5 gives me 70,000, right? So that's the depreciation per year. So I said 15% times the current depreciation per year, it gave me 10,500. I subtracted 104,544 minus 10,500, which is the fixed cost, minus depreciation per year for the current assets, which is 70,000. That gave me 24,044. I subtracted 28% of this amount, 28% of the tax, right? And that gave me 6,732, right? So this is the tax. Then I said the operating profit minus the tax, and that gave me the net operating profit after tax of 17,311.68. And then I added depreciation, and you always add back depreciation, and that gave me the operating cash flow of 87,311, right? So I did the same for the proposed asset. We were told that by purchasing the new asset, output is going to increase by 19%. Output is going to increase by 19%. So I increased 6,600 by 19%, and it gave me 7,854. You can say 6,600 multiplied by 1 plus 19% to increase that by 19% plus 19. And then if you do that, you should get this answer, 7,854. Let me see maybe if I can write it. Yeah, we said 6,000, right? 6,600, and then we increase it by 19%, 1 plus 19%, right? 1 plus 19%. So if we increase 6,600 by 19%, we get 7,854. Then we were also told that the selling price, by changing assets, the selling price is going to go down. We were told that the selling price would go down by 8% per unit, decrease the selling price by 8% per unit. So to get the 16.56, okay, to get the 16.56, we said 18, which is the current selling price, multiplied by 1 minus. We were told it would go down by, go down by 8%. So we say 1 minus 8%, 0.08. And then if we do this calculation, it will give us 16.56. Okay. So that gives us the selling price, and then we get our selling price, then we subtract our variable cost, 12% of selling price, it gives us the gross profit, 15% of depreciation to get the fixed cost. Remember, we calculated the installed cost of the new asset to be 770,000. That was the installed cost of the new asset. And we know that to get annual depreciation, we take the installed cost of the new assets divided by its useful life. So if you say 770,000 divided by 5, you get 154. That's the annual depreciation. So 15% of that gives us the fixed cost. 154 is the depreciation. We subtract 114,454.77, subtract the fixed cost, subtract the depreciation, and we get the operating profit. So they actually made an operating loss. So when you make an operating loss, you don't subtract tax, you actually add it. So you can see there's a plus there. So we say plus 28% of this amount, and we get 17,540. Remember, if you make an operating profit, an operating loss, you get a tax benefit. So we add and we get 45,104.57, add back depreciation, and then we get the operating cash flow. And then lastly, we just say proposed minus current to get the increment, proposed minus current to get the increment, proposed minus current to get the increment, and we keep doing that until we get to the bottom, and we will get the same answer when we say proposed minus current. So we get an operating cash flow of 21,583. So remember, if we were just looking at an expansion, and if we were not replacing an existing asset, we would just be concerned with the operating cash flow of the new asset if it was just an expansion problem. But if it's a replacement problem, we look at proposed and we look at current when we get the increment. Sometimes they can even start by giving you the increment here and then you just work downwards. But sometimes they start with proposed and they want current, then they want you to get the difference. And please remember the basic structure of an income statement. In the exam, they could start anywhere here. They could start with operating profit or gross profit. You need to be comfortable with starting anywhere to be able to get to the operating cash flow. And lastly, always remember to check to see if the fixed cost includes depreciation. If the fixed cost includes depreciation, you don't subtract depreciation again. If it does not include depreciation, you need to subtract depreciation. Okay. Lastly, the last type of cash flow you need to know about is the terminal cash flow. The terminal cash flow. So remember, we purchased the new asset. So at the end of the life of that new asset, we might sell that new asset. It's possible that at the end of the life of an asset, you might sell that asset and you might get money. So at the end of our project, we might decide to sell that asset that we had bought at the beginning. And we define the terminal cash flow as follows. This is the cash inflow resulting from the sale of the new asset at the end of its life. So let's say that new yogurt making machine that Parmalat purchased. Let's say Parmalat purchased this new yogurt producing machine. Let's say 5 years of that new machine have passed, and they now want to sell that new machine. The cash flow associated with selling that new machine is known as a terminal cash flow. This is the cash inflow resulting from the sale of the new asset at the end of its life. And to calculate this terminal cash flow, we use the following template. We take the after-tax proceeds. From the sale of the new asset at the end of its life, and then we put the answer right there. We take the after-tax proceeds from the sale of the new asset at the end of its life, and then we add or subtract the change in net working capital again, and then we add or subtract the change in net working capital and we put it there, and then we get the terminal cash flow right there, right? So this is the cash flow associated with selling the new asset at the end of its life. So to calculate this, we need to be able to calculate the after-tax proceeds from the sale of the new asset at the end of its life. To get the after-tax proceeds from the sale of the new asset at the end of its life, we take the selling price of the new asset at the end of its life, plus or minus tax. And remember, to calculate tax, we take the selling price of the new asset at the end of its life, minus the book value of the new asset at the end of its life times the tax rate, right? And remember, sometimes you have to calculate this book value. And also, importantly, remember when we calculate tax, if we get a positive answer, it means we make a profit. So we have a tax expense here, we subtract tax. If we get a positive answer here, it means we subtract tax here. If we get a negative answer here, it means we have a tax benefit and add tax here, okay? Then to get the book value of the new asset at the end of its life, here, you really don't have to do a calculation for this one. The book value of the new asset at the end of its life is almost always zero. Every question that you come across, it's always zero in this module. The book value of the new asset at the end of its life is always zero. But if you just want to confirm that, you can still do the calculation of taking the installed cost of the new asset minus the accumulated depreciation. But you will always get 0 here, right? So the last part with regards to calculating the terminal cash flow is the addition or the subtraction of the change in net working capital, right? So at the end of the life of an asset, at the end of the life of the asset, an opposite adjustment is made for net working capital, right? So at the end of the life of the asset, an opposite adjustment is made for net working capital. So remember, for the terminal cash flow, we need to add or subtract the change in net working capital. And when we also calculated the initial investment, we also had to add or subtract the change in net working capital. When we are working with the terminal cash flow, right, we make an opposite adjustment to what we did in the initial investment, right? So at the end of the life of an asset, meaning when we're calculating the terminal cash flow, an opposite adjustment is made for the net working capital. Therefore, if for the initial investment we added, let's say when we calculated the initial investment, let's say here, when we were calculating the initial investment, if we added the change in net working capital, for the initial investment, if we added the net working capital, if for the initial investment we added the net working capital, then for the terminal cash flow we subtract. So if we added for the initial investment, it means when we come to the terminal cash flow calculation, we are going to subtract here. And if for the initial investment we subtracted, it means when we do the terminal cash flow calculation, when we come here, we're going to add. Okay, so we make the opposite adjustment. And I'll give you the reason. It can be a bit confusing, so I'll try to explain it as slowly as possible. Remember, we said that if our net working capital increased at the beginning of a project, it means that money went out. It means that the company spent money, right? So we said we subtract because the company spent money and our net working capital has increased. Now, that money that was spent at the beginning is recovered at the end. It's recovered when we terminate the project. So when we recover that money that went out, to calculate the terminal cash flow, we add back that money. So it's actually recovery of money that we spent at the beginning, and then at the end, that money comes back in. So we add it to the terminal cash flow calculation. On the other hand, let's say that our net working capital had gone down, meaning that money came in, and then for the initial investment, we added that net working capital that had gone down, resulting in money coming in. So we assume that when we terminate the project for the terminal cash flow, when we terminate the project, that benefit that we got by money coming in as a result of net working capital is going to go. That benefit is going to go. And because we added initially, we now have to subtract when we terminate that project as that benefit is going. So that's why we always make an opposite adjustment for net working capital from what we did in the initial investment. So just to make it easy for you, remember that whatever adjustment you made for net working capital in the initial investment, you make an opposite adjustment when you're calculating the terminal cash flow. So let's finish off this video by looking at assignment 1, semester 1, question 1.3. So with this question, they want you to calculate the terminal cash flow of the new machine. In other words, they are saying calculate the cash flow associated, the cash you get associated with terminating the new machine or with selling the new machine at the end of its life, right? And the template for the terminal cash flow is the after-tax proceeds from the sale of the new asset at the end of its life, plus or minus the change in net working capital, right? So let me take you through how I got each of these amounts. Okay. So to get the after-tax proceeds from the sale of the new asset at the end of its life, we take the selling price of the new asset plus or minus tax, okay? So the selling price of the new asset at the end of its life was given. It was given right here. We were told that the new asset can be sold at the end of its life, and it can be sold for 150,000 Rand after 5 years, right? However, we were not given tax. We had to calculate tax. And to calculate tax, we used this formula. We took the selling price of the new asset minus the book value of the new asset at the end of its life, multiplied by the tax rate. And like I told you, the book value of the new asset at the end of its life is almost always 0. So I just said 150 minus 0 times 28%, and I got 42,000. So this was the tax. And then because the answer was positive, it means we made a profit on selling the asset. And if we make a profit on selling this asset, it means we have a tax expense. That's why this 42,000 was put as a negative, because we got a positive tax here. So it becomes a tax expense. So 150 minus 42 gave us 108,000. And that was the after-tax proceeds from the sale of the new asset at the end of its life. Then lastly, the change in net working capital. If you remember, when we calculated the initial investment, we got money coming in. Our net working capital decreased, and that resulted in money coming in. And I said when we do the terminal cash flow calculation, we make the opposite adjustment. That money that came in now goes out because we are selling the asset. So we put the change in net working capital as a negative. And then we say 108 minus 7,000, and that gives us 101,000, which is our terminal cash flow. Okay, so that's how you work with a question like this. That's how you would calculate your initial investment and your terminal cash flow, and that's how you do calculations associated with capital budget and cash flows. Of course, they might change these questions slightly, like it won't always be the same, but the differences won't be very significant. And I think what I've taken you through should give you a proper background that you shouldn't struggle too much if you come across any capital budgeting questions. So in the next video, I will take you through capital budgeting techniques through a certain question that I'm going to ask you to practice. I'll introduce you to capital budgeting techniques. So what you can do, you can look at the following question. I'll just put it up. Look at this question right here. Starts here. I'll just scroll down. Go through this question and try to answer these questions. Try to determine the initial investment, the operating cash flows each year, and the terminal cash flows just for practice. Right? Go through this question. Maybe let me fit to actual size. Yeah. So you can go through this question. Try this question, and then in the next video, I'll take you through capital budgeting techniques based on this question. What I just want you to look at in this question, I want you to practice calculating your initial investments, operating cash flows each year, and determining the terminal cash flow. Okay. So thank you very much for listening. If you have any queries, anything you want to ask about, feel free to let me know on WhatsApp or give me a call. Remember, I might not always be able to respond promptly due to other commitments and business, but I'll try to get back to you as soon as I can. Thank you very much for listening.